Hello, don't forget to spread the love. Hit that like and subscribe button to keep the good vibes flowing and support our channel's growth. Thanks a lot. Now let's get this started. So, why is this indicator important to Forex traders? The Job Openings and Labor Turnover Survey, JOLTS, job openings report can really shake things up in the world of Forex trading with the US dollar. It's like having a secret window into the US economy and what the money masters at the Federal Reserve might do next. Here's how. 1. Indicator of economic health. A ton of job openings usually means the job market is rocking and the economy is on fire. Forex traders see this and think, hey, the USD is looking good. This can boost the dollar's value. 2. Influence on Federal Reserve policy. The Fed, which is like the boss of all banks, watches the labor market closely. If JOLTS shows strong data, it might signal a tight labor market, prompting the Fed to raise interest rates to keep inflation in check. Higher rates? You guessed it, that makes the USD more attractive to investors, giving it a nice lift. 3. Market sentiment and confidence. When JOLTS data is positive, it's like giving a high five to investors, boosting their confidence in the US economy. More confidence means more demand for USD assets, which can push the dollar's value up. 4. Comparative economic performance. Forex trading often feels like a big competition, with traders comparing economies. Strong JOLTS data can make the US look like the star player, making traders favor the USD over other currencies. 5. Expectations and speculation. Traders love to play the guessing game about future economic conditions. If JOLTS data beats expectations, it can lead to speculation about faster Fed rate hikes, which is good news for the dollar. If the data is weaker than expected, the opposite happens. 6. Correlation with other economic indicators. JOLTS data works hand in hand with other reports like non-farm payrolls and unemployment rates. Together, they give a full picture of the labor market. Strong data across the board can make the USD look even more appealing. 7. Risk appetite and safe haven flows. In times of global economic uncertainty, good US economic data, including JOLTS, can make the USD a go-to safe haven. If the data is weak, though, it can lose some of its sparkle. What is the JOLTS job openings? The Job Openings and Labor Turnover Survey, JOLTS, is a monthly report from the U.S. Bureau of Labor Statistics. It's like a big checkup on the job market, measuring job openings, new hires, the number of employees who quit or were laid off, and other job changes. Why is it important? JOLTS is super important because it gives a detailed look at the job market's health, which affects how much people spend, how businesses invest, and overall economic growth. What are the key points? Job openings. Lots of job openings mean the job market is strong and businesses need workers. Quits. A high number of quits shows that workers feel confident they can find better jobs. Layoffs. Lots of layoffs can be a warning sign of a struggling economy or industries in trouble. By looking at JOLTS data, policymakers, economists, and investors can make smarter decisions based on what's happening in the job market. Who releases it? The U.S. Bureau of Labor Statistics, BLS, is the team behind JOLTS. They collect, analyze, and share crucial economic info about the U.S. job market. How is it collected? BLS sends out a survey to about 16,000 businesses across different industries and regions. JOLTS gives a detailed picture of the labor market by tracking job openings, hires, quits, layoffs, and other job changes. When is it released? JOLTS is released every month, about 35 days after the month ends. What value does JOLTS job openings offer? JOLTS offers several cool insights into the U.S. job market. One, Labor Demand Indicator. JOLTS shows how many job openings there are, giving a sense of labor demand and the economy's strength. 2. Hiring Trends. It tracks how many positions are being filled, reflecting business confidence. 3. Separation Rates. JOLTS reports on quits, layoffs, and discharges. Quits are key because they often signal worker confidence in finding new jobs. 4. Labor Market Tightness. By comparing job openings to hires, JOLTS can show how tight the labor market is. High openings relative to hires suggest employers are having a hard time finding candidates. 5. Economic Policy and Planning. Policymakers, economists, and business leaders use JOLTS data for crafting economic policies, workforce planning, and business strategies. 6. Sector-specific insights. JOLTS data, broken down by industry and region, provides insights into specific sectors and areas, highlighting local labor market trends. 7. Turnover and retention analysis. Understanding why employees leave their jobs helps address issues related to employee retention and workforce stability. What are the cons? While JOLTS is super useful, it's not perfect. 1. Lag in data release. JOLTS data comes out about 2 months after the reporting period, making it less handy for immediate decisions. 2. Survey response and coverage. Not all businesses respond, leading to incomplete data or potential biases. 3. Potential for misinterpretation. High job openings might mean a strong labor market but could also show hiring difficulties. 4. Volatility and seasonal adjustments. The data can be bumpy month to month, and seasonal adjustments might not always hit the mark. 5. Lack of granular detail. JOLTS might not offer enough detail for specific industries or regions. 6. Doesn't reflect underemployment or job quality. JOLTS measures job openings, hires, and separations but doesn't capture underemployment or job quality. 7. Relies on employer reporting. The accuracy of JOLTS data depends on employers reporting accurately. 8. Doesn't capture informal employment. JOLTS focuses on formal jobs and might miss trends in informal or gig economy jobs. 9. Revisions. Initial JOLTS data can be revised, changing interpretations of labor market conditions. In summary, JOLTS job openings data can be a big deal for Forex trading with the USD. It helps traders get a sense of the U.S. economy's health and future monetary policy moves. Positive data can give the dollar a boost, while negative data can have the opposite effect. Forex traders keep a close eye on JOLTS data to shape their strategies and anticipate market moves. Think of the Forex market like a garden, where JOLTS data is the rain that helps the dollar bloom or wilt. Thanks for watching.